Mark Dannenberg is here with us. He's our next presenter. This is He's got a great topic for us today, and there's his pretty picture. Mark, let's go ahead and get you talking to us. Can you hear me, Mark?
Jeffrey.
Hey, how are you?
I'm great. I'm sorry to hear you have snow. It's nice here in California.
Oh, we're going to get like probably 10 inches by 8 o'clock. So
Wow.
it'll be a fun
Good for the
commute.
skiers.
Yeah, exactly. It might be a good sledding day. So what do you want to tell us about yourself, Mark?
First of all, I'm excited to be here and I appreciate the opportunity. I spent 26 years as a senior executive with ADP and loved what I did, but I always had a passion for trading. I kind of learned, through my early years as I was working in corporate America. And at some point I decided that this was an opportunity to eventually have some lifestyle freedom because trading would offer me an opportunity to benefit from being able to choose whatever I wanted to do whenever I wanted to do it, right? You can travel as often as you want. You can go wherever you want, stay for as long as you want. And that was very appealing to me. So lifestyle freedom was what I was looking for. Ultimately, when I left my job after 26 years, which I really loved, but I decided to move on to do other things, a lot of people asked me why I was leaving and what I was going to do when I left. And I started telling them about trading options, which is pretty much what I've done for the last 30 years. And one thing led to another. A lot of people asked me how they could learn, and I hadn't planned on starting a business to help other people learn when I left ADP, but I did so because I had so many people asking how they could learn. So I have to tell you, Jeff, that I enjoy what I do every day now. I get to teach people basically how to benefit from 30 years of options trading experience that I have, and I enjoy that. So you ready for me to just go into my presentation?
I'm going to get out of the way.
Okay. Can you see my screen okay, Jeff?
Yeah, I hear you great too. So the
Okay.
technology is holding up, knock on wood.
All right. Perfect. Perfect. Thank you. All right. So first of all, I appreciate everyone spending a little bit of their time with me today. I'm going to be talking about the art of trading, how to simplify your trading and grow bigger profits. Now, I'm a big fan of simplifying trading, and simplification in trading can apply to people who are just starting out with options trading, maybe are a little uncertain about what to do. They might have attended a webinar, might have attended a seminar, might have read a few books, but don't really know where to start. And we like to help people thread the needle. I'm going to show you how to start your trading in a very simple manner. And then for people who are more advanced in their trading, maybe they've hit a rough patch, maybe they need to back up and regroup and think about what to do next. I think that this is a great opportunity for you to also rethink perhaps some of the complexities you have involved in your trading and simplify it. So I already talked about this. 26 years I was a senior executive, been trading for 30 years, teaching for 10, founded Options Moneymaker in 2009 formally to help traders learn. But one of the things I wanted to emphasize here too is I'm not just a trading educator, although I do really enjoy helping people learn. I host a live trading room every day. So I'm very actively involved in the markets. And in my trading room, we're trading a live account. We're trading a real cash account. This is cash that belongs to me, and we're trading that in front of an audience. So it's kind of hard to hide anything, which I hope nobody out there has a desire to do, but everyone in my trading room sees every win, every loss, every challenge we have, and how we navigate our way through that. So when I talk about simplified trading today, I'm going to talk about some of the simplest aspects of trading and how you can get started, and then if you have a desire, certainly advance your trading into more active live trading room trading. But anyway, I'm active in trading and coaching every day, and I did ultimately achieve the goal I had of learning how to trade options, and I enjoy lifestyle freedom. My wife and I travel wherever we want to go, stay for as long as we want. As long as I've got my computer and internet connection, um, I get to actually enjoy that lifestyle freedom. So the people that are going to benefit most from this presentation are beginning traders. If you're really looking for a way to get started, you have a basic understanding of options, basic characteristics of options, but you're kind of scratching your head wondering, what do I do now with that? How do I actually jump into the pool and not drown? Pay attention. I'm going to give you a way to simplify it and get started. Experienced traders, if you're looking for some greater success, maybe you'd like to learn how to earn more while also simplifying and spending less time trading, this is also targeted for you. Anyone who's committed to learning a lifelong skill, knowledge can never be taken away from you. So if you learn how to trade options successfully and you always have some amount of capital to get started with, you can generate an income for yourself. And that's something that gives a lot of our clients peace of mind, because jobs can be taken away from you, businesses can suffer, but you can learn how to trade, and then you can trade to generate income pretty much any time in your life. And you're going to find later on, I'm going to share with you, it doesn't take a lot of money to grow a bigger account. And then if you're just looking for a simple way to trade and earn and minimize fear, we focus a lot on taking away the fear and anxiety. It's been one of our big focuses this past month with all of the volatility, all of the major financial news headlines that are perpetuating fear and anxiety. I mean, some of the most ridiculous headlines I've seen. People talking about, I just built a new swimming pool and I'm probably better off to fill it with beer than water because this market is in such bad shape. Using words like contagion in the market. It's just kind of absurd in my opinion. What we do is we keep our heads down, we focus on what we need to do, we apply our rules, and we don't obsess about what else is going on. We just generate profits. And by the way, with the Dow down 5.5% in January, the NASDAQ having the worst year since 2010, our live trading room account was up $61,000 for the month. So we're pretty happy with that, and we'd like to help people learn how to get started in that direction. What I'm going to be talking about today is credit spreads. Now, credit spreads is what I'm focusing on because it is a simple directional strategy. It really is one of the simplest options strategies out there to trade, and it's one of the most forgiving strategies, and I'll talk a little bit about that. But unfortunately, although it tends to be one of the simplest spread strategies available for new options traders, a lot of traders fail at trading credit spreads. And after talking to literally thousands of traders over the last 10 years, I mean, I've had as many as 500 people in a weekend seminar teaching them credit spreads. And talking to them, I learned that they fail because of a few basic things that we can help fix. Improper selection of strikes. They don't really understand how to choose the positioning of their strikes. They have insufficient time built into the position. They don't allow enough time for that position to play out. Most people also, and this isn't just true with credit spreads, but it's true in a lot of trading, they have a very naive assessment of their true risk. Too much risk on, and unfortunately people realize they have too much risk on when it's too late. It's when the position starts to, when the market starts to move against their position, that then they become filled with anxiety, fearful about their position, when they realize, well, I really don't want to have that much risk out there. And then most traders don't really have an adjustment strategy. They don't really understand how to manage, move, and adjust options so that they can optimize their outcome. Knowledge of how to properly manage a position, how to adjust a position, is going to significantly improve an options trader's success. So those are some of the things that I've found that interfere with an option trader. So what we're going to talk about today is how to trade credit spreads with a minimal true risk. I'm going to talk about the forgiveness factor, and I'm going to talk about how to properly build time into the position. I'm going to talk about selecting strikes and expirations, how and when to adjust a trade, give you an example of that, and then we'll talk about also compounding for bigger account growth. I'm going to talk about charting, and I'm going to talk about the simplicity of charting. We talk about how to start your charting with a very, very simple, basic analysis. Don't make it overly complex at the beginning. You want to start small, and then you want to build from there. If you can build a core basic knowledge and understanding of what you're doing, then you can add other elements of understanding on top of it. It's like going to college. You start with 101 level courses, and then you move on to 200 level courses and 300 level courses, and you're building on your knowledge. You don't jump right into 400 level courses. So let me first of all talk about the forgiveness factor. Now, the forgiveness factor is a term that we use at Options Moneymaker, and it's basically saying that when the price of whatever you're trading moves against your position, you can still make a profit or potentially break even. Forgiveness factor is all about placing natural barriers between the current price of the underlying stock or index and your risk strike, and I'm going to identify and define the risk strike for you here in just a moment. It's about being wrong on the direction when you took a directionally biased trade, or it's being wrong on the timing of entering that trade and still potentially having the ability to win. So I'm going to share with you how that forgiveness factor works with a credit spread trade. Now, I'm going to give you an example of a credit spread trade here just to get everybody on the same playing field and make sure you understand what a credit spread is and how a credit spread should be properly constructed based on the way we teach clients at Options Moneymaker. First of all, the example I'm showing you is setting up a credit spread on NDX. That's the NASDAQ 100 index. Now, I'm going to talk about what we trade a little bit more in a few minutes, but essentially we trade indexes. We don't trade ETFs, although this works on ETFs. We don't trade futures, and we trade very, very few stocks. We trade the indexes. That's one beginning level of simplifying your trading, is narrowing it down to a handful of or a very limited number of equities that you want to trade. So we're going to give you this example on NDX. So at the time that we were looking at this trade, NDX was trading at 45.30. Now, that was during the first week of the month. And we saw on our chart, our very simple chart, which I'm going to show you here in just a moment, declining bias. And what we decided to do was to take advantage of that declining bias by opening a credit spread. And we sold to open a May week 3 position and bought to open another May week 3 position. NDX trading at 45.30, we sold to open the 45.95 call and bought to open the 4600 call. Now, the risk strike is the 45.95. The risk strike is always the strike that you sell to open when you're constructing a credit spread trade. That risk strike is always going to give you more credit than the other leg will cost you. And that's why this spread is called a credit spread, is because the net difference between the credit on the 45.95 and the net debit on the 4600 is going to create a credit to you. So there are a few things about this trade that I want you to understand to have a good comprehension of credit spreads. First of all, in our example, the credit on this trade was $1.60. Now, the risk on a credit spread is always limited to the difference between the strikes. So in this case, the risk was $5. Now, the numbers I'm giving you are on a per share basis. So options are traded in 100 share lots. One contract is 100 shares. 5 contracts is 500 shares. So it's a multiple of the number of shares that you're trading, but I'm giving it to you on a per share basis. So if you have $5 of gross risk, that's the difference between the strikes, and you took a credit of $1.60, you actually have $3.40 of net risk on that trade. If you put this trade on and just let it go to expiration, didn't do anything with it, and you had a full loss on the trade, which we would work real hard to avoid, but if that was the outcome, your loss would be $3.40 because you took in $1.60 when you opened the trade and you have $5 of gross risk on the trade. The $3.40 is the number you should use to decide how many contracts you want to trade. And that's going to hopefully guide you to using the number of contracts, opening the number of contracts that are reasonable, a reasonable amount of risk relative to your account size. And I'll talk a little bit more about that in just a little bit. So a couple of other things. As long as NDX stays below 45.95, we have a profit on this trade. We just don't want it to move above 45.95. So what that means is we've got a 65-point forgiveness factor on NDX, 65-point forgiveness factor. Now, the forgiveness factor is going to be different on different indexes, and it's going to be different at different times on NDX. It's not always 65 points. Sometimes it could be more or less depending on the amount of volatility there is in the market. And the way we construct trades, volatility naturally plays into the structure of our position. We opened a credit spread the other day, and we were 150 points out of the money for a forgiveness factor of 150 points. So in this example, the NDX could move up 65 points and we would still have a profitable trade. So what we've done is we've constructed a position that has a declining bias. We really want to see NDX move lower, and that's what we thought would happen. But if it moves against us, if we were wrong, or if it moves against us before it moves for us, it can move up 65 points and we'll still have a profitable trade. The other thing is we allow 2 to 4 weeks to expiration for our trades. When you're trading credit spreads, 2 weeks to expiration, 3 weeks, 4 weeks to expiration is a good amount of time to allow the index to move against your position and then potentially move favorably for your position. It just gives us time to be able to manage and adjust the trade when necessary. So the forgiveness factor and the amount of time you put into the trade are two very important elements for setting up a successful credit spread trade. Forgiveness factor will depend on where we see the placement of our strikes on the chart, which I'm going to show you in just a moment, and time should be 2 to 4 weeks to expiration. Now, the factors we considered in setting up this trade were that at the time that we set it up, NDX had traded up to a 15-year high of 45.6233. That we placed our risk strike 33 points above that highest high in 15 years. Now that doesn't guarantee that the price isn't going to move higher because, you know, a few months later it did move higher. What it does though is it puts a natural barrier between the current price of the index and our risk strike. And when we move up to 15-year, multi-year highs, the markets start to lose some of their momentum. It doesn't mean that we won't continue to move higher, but it's one element of a natural barrier. We also use Bollinger Bands. Now this is how simple we advise people to start. And I'm going to show you a chart here in just a minute. Very, very simple chart. And MetaStock is one of the premier stock chart services available, and yet you can start very, very simply to begin your trading and feel confident with what you're doing. We use 2 and 3 standard deviation Bollinger Bands, and at the time the 3 standard deviation Bollinger Band was at 45.80, and our risk strike was 15 points higher than the 3 standard deviation Bollinger Band. Now what we know is that when the price hits the Bollinger Band, it has a tendency, a bias, to move in the opposite direction. Again, it doesn't guarantee that that's going to occur immediately, but it is one more natural barrier. And then we had 2 levels of resistance between the current price and our risk strike, and I said 3 weeks here, but we actually had about 2.5 weeks to expiration, which allows us time to adjust the trade. Now this is just a very simple chart view, and this is how simple we help our clients start their trading. First of all, the blue lines are the Bollinger Bands, and the inner set is the 2 standard deviation Bollinger Band, and the outer set is the 3 standard deviation Bollinger Band. And one of the things that you'll see on these indexes as you become familiar with them is that the price tends to move up to the upper Bollinger Band and then retreat and move to the lower Bollinger Band. It doesn't mean it won't walk along the upper Bollinger Band or walk along the lower Bollinger Bands for a period of time, but when price reaches those levels, uppers and lowers, it's starting to hint at the fact that you'll see a reversal and see a contrary cycle. So here is the time period that represents the credit spread I was giving you as an example. Our risk strike is 45.95. The new high that had occurred at 45.62 was a 15-year high. And so what we knew is for our risk strike to actually be at risk, for our position to be at risk of loss, the price of the index would need to move above the 15-year high, above the 2 standard and the 3 standard deviation Bollinger Band, and it would need to move above the declining line of resistance that we had identified on our pattern. So that, once again, does not guarantee a successful trade. It's just stacking the deck in our favor, and then if it did move higher, we have some management and adjustment techniques that we would use in order to help us still earn a profit on that trade. And I'm going to talk about those in just a moment. This type of trade is very simple to identify. A credit spread is very simple to set up. Once you've set up a couple of them, it'll become very easy for you to do. This trade benefits from time, which is 2.5 weeks to expiration, and it also benefits from the forgiveness factor that I spoke of. So that's the simplicity, but we also like to simplify the closing of our order. For this type of trading, this is trading that is good for people who have jobs, who own businesses, who have busy, active family lives or other things that they want to do. They may love to trade, they want to be involved in the markets, but they don't have the time to sit with us in a live trading room. This is the type of trading that you can do in 15 to 30 minutes a day by looking at your charts for possible new trades, by reviewing your existing positions, and I'm also going to give you a very simple way to review your positions, but then also by automating the close of your trade. I personally believe that the sweet spot for closing a credit spread is a 10% return. A 10% profit on my spread is a good guideline to follow. And so what we do at Options Moneymaker is we show people how to set up a good till canceled order to close for a profit of 10%. Now 10% is based on the 5 points of gross spread risk. So if you have a 5-point difference between your strikes, 5 points of gross spread risk, you're going to be looking for a 50-cent return. So a 50-cent profit on a credit spread, we're going to set a good till canceled order to close out that trade for a 50-cent profit. So in the trade example that I showed you, where we took a credit of $1.60, we most likely would set a good till canceled order to close to pay back $1.10 of that $1.60 and keep the 50-cent profit. Now a lot of credit spread traders will hold their positions until expiration. That is the way to maximize their return. I will tell you that especially when you're trading indexes like this, it's a great way to maximize your risk, because the longer you hold, the more likely it is that the index is going to cycle in the opposite direction. So what we like to do is take a quick capture of a profit, and then we like to recycle that capital back into a new trade immediately and do some compounding of our profits. And I'll show you what the effect of that is in a program that we teach our clients how to do. Now, credit spread can also be used to create a non-directional position, and that's what is referred to as an iron condor. Now, I didn't create these strategies. What I did over the last 30 years is learned how to use an optimum approach for that strategy, how to position these strikes properly, how to position the timing properly, how to build the forgiveness factor in. So as I said before, they're very commonly traded positions, but a lot of people will fail trading credit spreads, and then they get frustrated and they give up and they feel like they can't trade anymore. And I hate to see that, because I went through a lot of that myself in the first several years of learning how to trade, and I kept coming back at it, and just decided that this was something that I really wanted to learn how to do, and I enjoy it so much. I want to help as many people do it also who have a passion and desire for doing it. So an iron condor is when you put together both a call and a put credit spread at the same time. So you're going to open both a call credit spread, which has a declining bias, and a put credit spread, which has a rising bias. Now, this eliminates the need to really assess the directional bias, although it's always advisable to look at the chart. I'm a huge fan of charts and technical evaluation, but you don't always have to do that when you're opening an iron condor, or you can be less precise about it. It's great. Iron condors are great for newer traders, especially who are not yet comfortable with their interpretation of the technical signals that a chart is offering them. Also, with an iron condor, you have a potential profit regardless of which direction your underlying instrument moves. One side of the iron condor is going to win on the move, and the other side is going to benefit from the forgiveness factor when the iron condor is appropriately constructed. So you can very easily set up an iron condor using Bollinger Bands as a guide for choosing the strikes. And then one element of simplicity, which I talked about before, is we only trade three instruments. We trade NDX, which is the NASDAQ 100, SPX, which is the S&P 500, and RUT, which is the Russell 2000. We only trade those three. We have so much activity on those three that there's no reason to look for anything else. And it also simplifies our trading. We tell people you can trade in 15 to 30 minutes a day. That's because you're only looking at three charts. And it's very easy to spot whether or not there's a new trade opportunity. So you're not spending a lot of time scouring the entire universe of optionable stocks. And this is really a great approach for new traders. Okay? They're great for iron condors because they have good consistent cycle patterns. I love trading them, and my favorite of the three is NDX. Now, some people may ask, what about the bid-ask spreads on these indexes? We teach you how to overcome the bid-ask spread. We basically trade at the mark, which is the midpoint between the bid-ask spread, and we get great favorable fills. If you're trading the bid-ask spread on these, you'd never make any money, but we teach you how to overcome that as a limitation. Now, both sides can be opened at the same time, or you can leg into each side as the index cycles. These iron condors are a great way to grab profits regardless of which direction the indexes may move. So I want to walk you through just one example of a trade that we set up. This was on RUT. This happens to be a trade where it did not start out as an iron condor, but we actually legged into the iron condor. We started by opening a call spread, and it was a 1280, 1285 call spread, and we chose those strikes because at the time the index was trading at 1260. 20-point forgiveness factor. I'm going to show you the chart right after I show you the example here, and you'll see exactly why we chose the strikes that we did. But it had a 20-point forgiveness factor to it. We took $1.40 of credit. So on 5 points of gross risk minus the credit of $1.40, we ended up with $3.60 of true risk on the trade. The next day, we were able to close that trade. And by the way, it had about 2.5 weeks to expiration. Fits right into that 2 to 4 week time frame model that we have. The next day, we closed that trade because the index moved down 10 points, and we had an opportunity to pay back 80 cents of the original $1.40 of credit we took in. And so we took a 60-cent profit. And so that's better than our 10% return, because 60 cents on a 5-point spread would be a 12% return. And this example of an iron condor is going to show you exactly why I personally believe it's better to take profits when they're presented to you in the 10% or better range, rather than hold out and hold on to that one single original spread until expiration. But that same day, as soon as we got out of the calls, we opened a put spread. Now, we still only have individual credit spreads. We don't have an iron condor yet. But we opened the put spread because the index had moved down to 1250. We recycled our capital immediately after taking a 12% profit, and we opened a 1230, 1225 put spread. Again, 2.5 weeks out, the index had moved down to around 1250, and we were 20 points out of the money, so a 20-point forgiveness factor. And we took a credit of $1.12. Now later that same day, the index moved back higher again, and it offered us an opportunity to get right back into the same call spread we closed out earlier in the day, and we sold to open the call spread for $1.30. At this point in time, we now have an iron condor in place, having already taken 12% return earlier that day. And the interesting and important distinction about an iron condor is you cannot possibly lose on both sides of the iron condor at the same time. You cannot lose on the put spread and the call spread at the same time. So when you look at the 5 points of spread risk, 5 points of gross risk, you only have 5 points of gross risk, even though you have a put spread and a call spread in place. And because you only have 5 points of gross risk, you have credit equal to $2.42. It's the combined credit between the puts and the calls. And so your overall net risk is considerably less on an iron condor than it is holding an individual either put spread or call spread. So then the following day, the index continued to move higher, and we bought to close the puts. We paid 60 cents to close the puts. Now what happens here is normally I would have been out for a 50-cent profit, but what will happen is in pre-market we'll take a look at what the futures are doing, and if the futures are pointing to a more significant move that would allow us to take a bigger profit, we may cancel the good till canceled order we have in place prior to market open, and then wait for the market to open and assess where the mark is and place our order to close. It just gives us an opportunity to take a bigger profit. And then a week later, we ended up closing the call spread. Again, we paid 40 cents of the $1.30 that we had taken in on that. So a summary of that trade is we were in the trade for 7 trading days, 9 calendar days. We ended up taking $1,010 of profit, and that is $2.02 of total profit per share, and we are trading 5 contracts, and each contract represents 100 shares. If you take the $2.02 and divide it by the 5 points of gross risk on the spread, that's a 40.4% return. So we took a 40.5% return basically in 9 days. This is all about opening and closing on the cycles and recycling capital for bigger returns. A lot of people will be suspect about the types of returns that can be made on options because they think in very traditional terms. They think of buying stocks or putting their money somewhere and thinking that off of that one investment they're going to get, some exponential return. That's not what this is. This is using the same amount of capital multiple times. It's recycling it over and over and over again and putting it into new positions. And that's one of the main reasons why with options trading you can generate some pretty significant returns. So here is a screenshot of a very, very simple view, the chart just showing where we ended up where we started opening the call spread, and then we saw the price move down to the lower Bollinger Band. And in our experience, in fact, one of the triggers that we trade off of is when the price moves below either the 2 or 3 standard deviation Bollinger Band or above the uppers. That to us is a trigger to say the price is most likely going to snap back sometime in the near future, snap back higher. So that would have been a trigger for us to say, let's go ahead and take the profit that we have on the calls and immediately open the puts, because this looks to us like a point in time where the price is going to snap back higher. And in fact, it did. And then we sold to open the new call again, and the price continued to move higher. We bought to close the put. Price bounced back and forth between the Bollinger Bands, as it always does, until we had an opportunity to buy back the second call spread. Now, sometimes even when you build a forgiveness factor into a position and you build time into the position, you may need to adjust it. And in my experience of doing this for 30 years, and I would say 20 years of those successfully, and 15 of those to a point where I could generate a consistent income on it. The rest of those prior years were all about learning and really developing strategies. There are 3 simple ways to adjust a credit spread. One is to roll it out. Now, options have a limited life cycle to them. It's like holding a melting ice cube in your hand. They're going to cease to exist at some point. And it's one of the challenges because you're fighting against that, time value. You're fighting against expiration. Now, if you have a trade that the chart is telling you that it's a good trade and you're just about to run out of time, you can very simply roll out that spread to a future expiration and add more time to the trade. It doesn't actually change your current situation. It doesn't change the fact that you may be behind on that trade. It doesn't change the fact that you have a drawdown on that trade. It just buys more time so that you can be successful with the trade. A reposition is the second method of managing, where you move the strikes further out of the money. So if the price has moved against your position and encroached on your strikes, encroached on your risk strike, but it looks like you're still set up to have a good trade if you have enough time, you may want to reposition by adjusting the strikes. And then the third approach is to do both. And that's really how simple this can be. You can roll out, you can reposition, or you can do both. The capital requirement to do those is generally very small, and it's a very simple strategy to execute. So one of the challenges for especially newer options traders is, well, when do I take action? And a lot of traders feel very confident getting into a trade, and then all of the confusion kicks in. They don't really know what to do. They don't know what they should be looking for. They don't know how long they should hold the trade. They don't know if they should hold it longer, try to let profits run, but they don't really understand what to do with the trade. So when it comes to credit spreads, we've defined 3 questions that we teach our clients to ask on each position each day. And this, again, is another way of simplifying your trading, trying to give you a set of rules, a structure to follow in your 30 minutes of trading allocation every day, tell you do these things, and it will help you know when to take action. So question number 1, is there a profit? Well, if there's no profit, then there's nothing to do. You don't want to close the trade if there's no profit and you still have a potentially good trade. Question number 2, is the risk strike in the money? Well, with a credit spread, you want the risk strike to be out of the money, so if the answer is no, there's no action to take. And question number 3 is expiration less than 1 week away? You always want to have time in your position so that you can maintain control of your position. And if the answer is no, there's nothing to do. So if the answer is no profit right now, my risk strike is not in the money, and expiration is not less than 1 week away, there's absolutely no action that you want to take that day on that position. And you're going to ask these same 3 questions every day on every position. Now, if there is a profit, this is where it gets a little gray because it's up to each individual trader what you consider a reasonable profit is. I already defined that for you. For me, it's anything north of 10%. And I'm not going to think twice about holding that trade or closing it. I'm going to close it, and I'm going to immediately look for a new opportunity to get into another trade. If the risk strike is in the money, that's the first clue that you may need to reposition. And if expiration is less than 1 week away, that is your clue that you may need to roll out. It's not complicated, and when you get used to asking these same 3 questions, you're going to see how simple your evaluation can be every day. So I want to give you an example of a trade on NDX and talk about managing the trade. This is an example of one that we ended up needing to manage. Now this trade started out as an iron condor. We opened both the calls and the puts at the same time. And you can see the strikes here that we used. The risk strike on the calls was 44.45 and the risk strike on the puts was 4,300. The difference between those two is 145 points. That's what we call our sweet spot. If the index remains in that 145 point range, we potentially have a profit on both sides. There was 2.5 weeks to expiration, and we built a 65 point forgiveness factor in on the call spread and an 80 point forgiveness factor on the puts because the index was trading at 43.80 at the time that we opened this iron condor. So a couple days later, we bought to close the calls. We had sold them originally for $1.66, and we locked in $1.01 of profit. A few days after that, the index cycled back higher, and we sold to open another set of calls. Now we used the same week expiration. We used the same difference between the strikes. We used the same number of contracts, but it was a different set of strikes. But as soon as we opened those, we're right back into holding an iron condor. And then a few days after that, we bought to close the puts on a move higher and took an additional profit. Now, I'm going to show you a chart so that you can visually see all of this here. But then what happened is the price moved above our call risk strike. Now, this is the second set of calls that we had opened. We've already taken profits on this trade so far. The strike moved above our 4,400 risk strike, and we were getting close to expiration. So in doing our 3-question evaluation process, it was our assessment that we needed to add more time to this trade. We needed to give ourselves a bit more time for it to play out. So what we did is we rolled out the trade. We rolled out, and the rollout is by setting up an order all on one order ticket to buy to close the call spread that we own and sell to open a new call spread to replace it. This is just a process of rolling out. Basically what we did was we closed the April week 3 call spread and sold to open the May week 3. It's the same position, same strikes. It's just that we now added 4 more weeks to expiration. In this transaction, we paid $3.40 to close the calls, and we received $3.20 to open the new calls. So this rollout transaction cost us 20 cents. So for the price of 20 cents, we bought more time. We didn't change our situation. We still have a drawdown on the position. We're still behind on the position. But if I'm going to be behind on the position, I'm not one who just cuts the position off, takes that loss, and moves on. That's just not a good way to trade, in my opinion. So we spent 20 cents for the right to have more time, and then a week later, where we were running right up against expiration of the original position, we were offered an opportunity on the next cycle movement to close out the spread and pay $2.20. So rolling out allowed us the opportunity to hold and wait for the next down cycle. So the summary of this trade is as follows. We were in the trade for 14 days, trading days, 18 calendar days. We ended up taking a $468 profit on this trade. That was 78 cents on 6 contracts. Now, that's less profit than what I thought we were going to end up having as when we started the trade and we were leveraging the cycles. But overall, we managed the trade and successfully got into, took a profit and took all of our capital back. That's a 15.5% return on 5 points of spread risk. So that's what can happen when you don't allow fear and anxiety and doubt to cloud your judgment, and instead you just evaluate your positions on a daily basis using the same 3 questions that we just shared with you. So managing rather than worrying about your trade, adjustments basically buy a lot of peace of mind. So here's the snapshot. You can see where the strikes were relative to the Bollinger Bands. And basically we used Bollinger Bands and support and resistance to open this trade. When the price moved down to below the lower Bollinger Band, we took advantage of getting out of that call spread, as I already shared with you. But at that point in time, we were also below the risk strike of our put spread. But we didn't take action. And the reason we didn't take action, and this is one of the reasons that we trade the indexes that we do, is because the indexes are European-style expiration, which means you cannot be exercised or assigned until expiration. American-style expiration, which most stocks and ETFs are, can be exercised or assigned at any time leading up to expiration. So when I found my risk strike in the money, but I still had plenty of time to expiration, I didn't have to worry, I didn't have to panic, I didn't have to be forced into taking action, I didn't lose control over my position. I could not be exercised or assigned, so I could just thoughtfully evaluate my position and give it a little more time. And I also saw that we were trading below the lower Bollinger Band, which tells me that we're going to be popping higher here very shortly. And that's exactly what it did. So we opened the new call here, we decided to roll out here, and then eventually we were able to close out of the trade here. So folks, this is all about simplicity. You don't start something that you want to learn by learning the most complex part of it first. You start by learning the simple, basic tools that you can use in order to trade successfully, gain some confidence, and feel good about what you do and earn some profits. So my summary is this is all about leveraging the cycles based on Bollinger Bands. Trading the indexes is a great opportunity to, again, simplify your trading. It's a great approach for newer traders, and it's a great approach for more experienced traders who just don't seem to be achieving the level of success that you desire. Build a forgiveness factor into each trade. It helps you be wrong, perhaps, on the timing or the direction, but perhaps right, profitable on the trade. Give yourself time in the position. You want to avoid that roller coaster fear and anxiety. Let me just tell you, there's a lot of that going on, a lot of that being talked about in the news in the past 4 weeks, and just tell you that our clients were actually enjoying all of the movements and the volatility because we were taking profits. And this really is how simple your trading can be. All right, so I just have a couple of things to share, and then I'm going to turn it over to Jeff, but we really would like to help you learn. That's what we're committed to. We have a program, we have several programs. Our 2 primary programs are our Profit Builder program, which is a great way for people to get started very simply, and then we have our recently announced Profit Accelerator program, which is for more experienced, more confident traders, and that's the Profit Accelerator program is for people who have an interest in participating in our live trading room. But the Profit Builder program is a great place to start. And so this is an offer to a chance to participate in a program that we started based on our live trades. With Profit Builder, we also trade a live account. Every single day, clients can see exactly what's going on in our live account. We suggest that clients initially allocate $5,000 of trading capital. I have people say to me, hey, I've got $500,000 of trading capital, so $5,000 is no problem. How much should I trade? My answer is always the same, $5,000. I personally If I had $1 million account, I wouldn't start with more than 5,000 until I felt very, very confident with the strategies and my comprehension of those strategies. So 5,000 is where we suggest people start with, and that's $5,000 of capital that you're willing to put at risk, which is going to be spread over 3 to 5 positions, not all in one position. Generally, as a rule of thumb, you should have an account size that is of 8,000 or greater where you're willing to trade 5,000 of it. And then what we're going to do is to show you how to recycle that capital and compound profits. So just as an example, we started the Profit Builder program last year around the first part of April. And we started with $5,000 of investment risk. Now, the live account that I created for this, I actually had $11,000 of account value. In the first 45 weeks of the Profit Builder program, we've taken profits of $13,137. Now, that's a 262% return on that initial risk of $5,000. Now, I don't believe that the Profit Builder program is showing optimum returns because it's based on the following email alerts. It's based on your learning and understanding, and we are influenced by the trades we take because we want people to be successful. We want you to follow along and learn, but our objective is to teach you how to think like a trader, not just follow a bunch of alerts, and if those alerts go away, you don't know what to do. But this is really a great way to start small and grow big and then expand not only your trading but expand your understanding. So here's something I'd like to offer to you. If you have an interest at all in what you've heard, if you're interested in our Profit Builder program, then the Profit Builder program is a 6-month subscription. And what you receive for 6 months is an email and text alert with the same trades we are opening, closing, and managing every day in our live account. Now, don't confuse this with our live trading room. These are not the live trading room trades. That's our Profit Accelerator program. But in the Profit Builder program, we have a separate account. We will open and close trades in that account, and we send out an email text alert whenever we do. So you have the choice and the option of following along with those trades. We're basically saying this is a trade that we took. You can follow along with it. We tell you the strikes, we tell you the expirations, we tell you the number of contracts that we're trading. We also tell you what we got filled at, and we give you some guidance as to how much leeway you should give yourself to fill that trade. But I think that that's only a small portion of the value of the Profit Builder program, telling you what the trades are. The real meat of it is that every day we send out a it's really a 15 to 30 minute education video. And that education video is showing you how to do a complete, deep, thorough analysis of each position that we have in play. We're going to show you on that video every day how we chose the strikes that we did, where they were relative to the Bollinger Bands, whether we opened an iron condor or a call spread or a put spread. We're going to show you the spread that we created, how much we took as a credit. We're going to show you what the risk is on that trade. It's basically us doing a full analysis for you. We're going to ask the same 3 questions I shared with you earlier on each position, and it's basically over a 6-month period, 5 days a week, every market day for 6 months, guiding you through the process of thinking like a trader. And I think it's a huge opportunity to learn how to limit your risk, simplifying your trading, and grow a big account. Now, if you make money during that 6-month period, that's awesome. If you didn't make any money, the education is invaluable in my opinion, and that's just based on my prior 30 years of trading, and I wish in the first 5 years somebody had showed me how to do this and just kind of threaded the needle for me. That didn't happen. I kind of learned a lot on my own. My CPA in the earlier years asked me why I was trading because I knew more about loss carry forwards than most of her clients. Well, I took that as a challenge and I dug in and I learned a lot, and I learned through a lot of trial and error. What I try to do is to teach people how to avoid the errors and guide them through to success. So if this is of interest to you, we are offering this for only $695 for the next 48 hours. And you can access it by the link optionsmoneymaker.com/builder, and that will take you right to the link to sign up. If you have any other questions, if you're more advanced and you're interested in a live trading environment and you have questions about that, this presentation, this offer is all about simplifying your trading. It's geared for a much bigger audience, but if you have questions about our live trading, you can feel free to email me directly, markd@optionsmoneymaker.com. So, Jeffrey?
Hello, yes. Good job, Mark.
Thank you.
Thanks for coming in today. How's everybody doing? All right. The website again is optionsmoneymaker.com/builder. I'm not sure I'm getting questions right now. Don't seem to have very many new questions, although the thing keeps updating. So if you have some questions, I'm going to try and figure out what's going on the platform so that we can answer them a bit later. But thank you, Mark. Let's go ahead and kind of transition back over to me. Really appreciate everybody coming today, all of our great speakers. Love this event. It's really one of my favorites. And with that being said, let's go ahead and get this back going. All right, so we will throw a quick shout out to our sponsor, Stocks and Commodities Magazine. In case you didn't hear me before, it's a great magazine. You should have a copy. If you buy any of the add-ons that we're actually going to be talking about today, you're going to get a 2-year subscription for free as part of it. And that includes all of their article they've ever published since 1982. So it's very, very cool. And with that being said, we are offering a free trial or an extended trial for MetaStock at metastock.com/traders-summit 3-for-1. The phone lines, I know a lot of people have been buzzing in with questions every time I go over there. They're just like slammed. It seems like they're a little bit lighter today, right now. So if you have questions about some of the stuff that we've talked to this point, give us a call, 800-882-3040.